All righty, here we go. Another Wednesday, February 18th, and got another great topic for you here, something that comes up all the time. So, welcome to another Water Cooler Wednesday. And by the way, if you like the show, please let us know. I'd love to hear that. Give us a couple likes on Facebook or whatever platform you see this on. It is rebroadcast on YouTube in full video, also popped up on X. So if you like it, please let us know. We do appreciate that, and share it with somebody as well, because we're always providing really good content on these for you, and put some time and effort into putting them together. So it's always nice to know who's out there listening and who's enjoying this. So thank you very much. I'm joined as always by Dwayne Gibbs. What's going on?
Happening? What's happening?
Well, the sun is shining here in Florida.
Nice.
You still got some snow on the ground, or are you cleared up?
No, we're clean. We're clean of the snow. We had some rain, cloudy for the next couple days, but I think Saturday's supposed to get like 73. So,
Yeah.
uh, living in Carolina, wait 20 minutes, the weather will change.
Yeah, my son is just past the Sierra Nevadas, and he showed me a picture this morning of the backyard, and he's probably got a good 6 to 8 inches of snow back there. And
Mm.
I don't know if you've seen what's going on in Donner Pass and all that stuff. I mean, they've got just like 10 feet of snow.
Yeah,
It's nuts.
hammered.
All the ski resorts in Tahoe from the south side to the north side are just loving it. But there's been some tragedies, man. There's been a couple avalanches and stuff like that. So pretty
Crazy.
crazy out there, but nice here. But getting on to what we're going to talk about here today, it's something that we're asked all the time, and it's usually answered pretty quickly. But I really wanted to delve into it and break it down a little bit further for everybody. And that comes down to, should you invest when it comes to real estate notes? And really real estate as a topic in general, but I'll focus on real estate notes. Should you invest in a real estate note fund or individual notes? Right. And we get that all the time because there's an attraction really to both of those items. And for somebody who's new to the business, which might pertain to a lot of you listening or watching this show, what's best for you? Because there's a lot of misinformation about these as well. So I thought I would break this down for you. We probably get more of this conversation at the national events, Dwayne. Would you agree?
Yeah, no question.
Yeah, because then people are exposed to a lot of these different things. Go, well, gee, I could just invest in a fund here, and they're going to pay me up to 8, 9, 10% versus when they do all the work versus me, looking at the notes. So it's an interesting topic here. So let me lay it out for you. Okay, so what is a fund? First of all, we'll start with the very basics. Everybody should kind of know this, but just in case, what is a fund? A fund is just a pooled and managed portfolio. An investor puts together an investment entity, a company, typically an LLC through a private placement, something like that, sometimes bigger ones, but they put together this organization and then they fund it. How do they fund it? They have investors kick in money. And now they've got a pool of money that they will manage. And with that money, they will, according to the documents that created that business entity, they will go out and purchase real estate notes, whatever the primary purpose is of that particular fund. They will management, they will oversee it, they will make all the decisions on all of that. It's completely managed. They take care of it for you. Typically, they will pay out some form of a dividend. It might be monthly, might be quarterly, might be annually, semi-annually. It's whatever's agreed upon, but don't always count on it coming in because sometimes in the fund business, they have to go, well, you know what? We don't have enough liquidity to pay the fees this month, so we'll see you next month, that sort of thing. So read the documentation, number one. And it's also important to know on the fund, are they specifically looking at performing or not performing notes? Are they excluded from doing one or the other?
That is important.
What's that?
I said that is important.
Oh, yeah, because one carries a lot more risk than the other one. One carries more liquidity than the other one. And if they can just buy whatever they want, that's a little bit different for you as an investor, knowing exactly what you are getting. So lower risk to higher risk sort of thing. So find out the purpose. And of course, if we contrast that to buying an individual note, what is that? Well, it's just direct purchase and ownership. You bought it, you own it. That's it. Okay. You outsource the management. as far as collecting the monthly payments, doing, getting the tax information out to people, following all the regulations, following up on late payments, all of that you outsource to a management company called a servicing company that will cost you $30+ per month, including escrow and everything else. And again, you can choose as an individual if you want to focus on performing or non-performing notes, or if you want to do some kind of combination. But the idea is, of course, you own it, you control it, you manage it, you're responsible for it. Okay, so that's the big difference. So do you want to handle that, or do you want to completely outsource that to someone else? That's what it ultimately comes down to. So I put together a chart comparing and contrasting these two because I think it's just the best way to look at it. So the next slide is going to have a lot of information. I usually don't put slides with that much information. It's hard to absorb. So all the information's there, but we're going to go a little bit line by line here. So on the left-hand side, on the left-hand side, you've got the note fund. Okay, that's the pooled investment. On the right-hand side, you've got the individual notes, which would be your direct purchase. Okay. So, line item number one, diversification. When you invest in a fund, you're going to have a lot of diversification, right? You can go across many different areas and notes. They're going to be buying in pools. Typically, the pools they buy, they purchase all at one time. So, they're located throughout the United States. It does reduce risk versus if you just have one note in one area, or you concentrate on buying all of your notes in one area. Okay, so what about the individual notes? Well, you do have, it says low there, okay? Risk concentrated in a few notes unless you buy multiple. So I wanted to make that point. Sure, if you buy into an investment fund, you're immediately diversified because you own a small percentage of all of that cash flow that fund generates. So you have instant diversification. If you're buying an individual note and you just own that one note, well, you're not diversified by its very definition, right? But if you start to build upon that, then you do start to diversify. Now, again, you can start to easily diversify that by just buying more notes. And with my training, if you've ever seen me do presentations, I don't care where the note is. I care about the deal. We think more like bankers, where's a good deal for this? Okay, and we have notes all over the place. So we just go to where the deals are. So yes, in the beginning, if you're buying an individual note, you're going to have very little diversification because, well, that's your only note, or maybe your two notes. Once you start to build that, then obviously you can very easily start to diversify at a greater level. So one's instant, one takes a little bit more time. Okay, but at the end of the day, you can diversify like a fund and have the control of that. Management, management effort. If you are in a fund, that's the whole idea. You don't manage it. You give that up to somebody else. Fund managers handling everything. Okay. You don't do anything, nor do you have the control. We'll talk about that, but you don't do anything. And the fund does all the work. Okay. If you're buying your own individual notes, you have to manage the due diligence. You've got to organize, get the servicing set up. You would have to hire the attorneys. You would have to, instruct people to follow through on the exit strategy. So there are decisions that you have to make. Okay. And so that is going to require some more of your time and effort versus a fund. Let's be fair with a fund. Hey, there you go. Here's my money. You manage it, hopefully wisely. Okay. With yourself, you want to be more actively involved. Make sure that you've done your due diligence properly, that you get it serviced, that you take care of the legal stuff, recording and everything else. And of course, you think in terms of exit strategies that you have to perform. Okay. So, Dwayne, am I being fair across the board? I'm a fan of
Yeah.
one side of
Yeah.
this, obviously, which is individual notes, and I want to make sure I'm laying out both sides of
Now
this.
this is the first I've seen this, so yeah, no, I think it's pretty you're just laying it all out there of exactly what it is. Yeah.
Okay. Capital requirements. Depending upon the fund. Now, there are some funds, and I put that here, that there are some lower entries that is accessible to small investors. That's not always the case. Okay. Sometimes it's accredited investors only.
I was
And
getting
if you're
ready to
not
say that.
accredited, you simply can't invest in that fund. There's a big difference there as well, everybody. And I want to stay on topic here, but a lot of funds today, they don't like dealing with small investors because small investors want their money back right away. Small investors are more concerned about every little thing. Small investors are upset if they don't get a dividend. Small investors want to cash out when they're not really entitled to, where accredited investors have a different mentality. They realize that hey, it does take some time perhaps, or we understand that there's no dividend being paid because of this, that, and the other. They're on an acquisition and they are less effort. But there are smaller funds that you can get into. I'd be careful of the smaller funds because sometimes in this business, everybody, if you don't have enough capital, $1, $2 million to do a fund is not enough. It doesn't buy you into a big enough discount. Okay, what it creates is really problems. You have $1 million or $2 million to deploy. That puts pressure on you to make investment decisions right away, which maybe you shouldn't make. And you can't buy in the big leagues where you're buying big portfolios and deploy a lot of capital like that. So you got to be really careful with those smaller funds. Are they out there? Yes. Check them out. Make sure you understand all of the things that are there. Most of them today are going to be higher. And what do we
Hey,
mean by higher? Yeah.
can I say something to that
Yeah.
about the accredited funds? What a lot of people don't understand is they think, well, if I get into the fund, I can ask questions and all. When they create these bigger funds, it's not, hey, they're having a meeting with you every single week to let you know exactly what's happening. And so people that, like you said, mom and pop that are getting into it that have $100,000 and this is all they have and they're really wanting to manage that tight. Those big funds don't do that. It's typically a quarterly um, report that
Statement.
comes
Yeah, exactly.
out
Yeah.
and lets them know what the fund's doing, whether it's dropped, whether, they had a gain, whatever that looks like. So, um, just wanted to
Yeah,
throw
and
that in
that's a
there.
yeah, it's a good no, it's a good point. I mean, yeah, that's the whole purpose. They're running the show, so don't expect, to be coddled.
A lot of hand
Yeah,
holding.
yeah,
Yeah.
you'll
Yeah.
get a quarterly report. So you'll find out how your money is doing several months down the road. So capital requirement again, yes, you might have funds that you can get in for 10 to $50,000. But look, when I say higher on the capital side for investing in individual notes, we're talking 20 grand per note. So how much higher are we really talking there? And I could very easily make the more argument, hey, if you've only got 10 grand to invest, why don't you save up a little bit and buy an individual note rather than putting that into a fund? You know what I mean? It's
Oh,
not
gosh.
that higher of a scale of entry. Have we purchased notes that are a little under $20,000? Yes. Are there notes that are as low individually as $5,000? Yes, but they come with problems too, everybody. You get a note that's too small and they don't pay you. What are you going to do?
It's no
Pay a lot
value.
more money to have it
Yeah. Yeah.
foreclosed, and what do you look? What are you trying to do? So you got to be careful with those as well. So okay, so it costs a little bit more maybe to get into a good $20,000 note than a fund, but again, you can just like your diversification, you can start to scale that by investing more, and maybe that's your own capital. Maybe you start to partner with people on that and start to build it up that way.
And
You
another
know.
point to that, Kevin, I think that you have way more control over that one asset that you purchase versus being into a fund, period.
Yeah, we're getting down to control. You can see on there.
Oh, yeah. Yeah.
Okay.
Yeah.
Yeah. Yeah. I know. There's
Sorry.
so many things. That's
Sorry.
why
I didn't
I was
mean to
trying to go
jump ahead
line.
of you. Yeah. Yeah. Shut up. Yeah.
No, I'm trying to keep it on track because I have a lot more
I
to say
got you. I
too.
got
And
you.
I
I
know you
got
do too.
you. Yeah. Yeah.
Potential returns. Okay. Funds will always tell you, and rightfully so, legally responsible, they will pay up to, keywords there, up to this percentage. That means anywhere from 0 to whatever percentage that they say. It's a target goal. It doesn't mean that's what they will accomplish. That's why you look at what's their previous history been. Can I see your previous history and what your record's been as far as meeting that goal? And they've got to keep it realistic, so steady to moderate returns. Most funds are looking at 8, 9% that they'll pay you, but there's some funds that are looking at 12%. And think of it this way. If I'm running a fund and I'm promising investors 12%, I have to be able to invest and make more than that. Otherwise, how do I make money in running the fund other than charging you, which is one way I could do it? I charge you a fee to run the fund. Or I get notes at 15%. I pay you 12 and I'm making 3% on the float using all of the investors' money. Okay. Is it easy to make 15% then in the note industry? No, it's not. No, it's not. It's very difficult to create a portfolio where you're making over 15%. Why? Because if you looked at all of the numbers in this industry, 10 to 12% is still where most transactions occur. Are there notes at 15%? Absolutely, there are. Okay. But it's not like I can go out and just, oh, I'm going to buy a pool of 15% yielding notes today. It's not going to happen, everybody. Okay. So that's why most funds today are on the low end of the spectrum going 8%, because at 8%, if I can buy on a fairly regular basis at 10 and 12, then I've got the capital spread that I need and I make both parties happy. Okay. So expect more funds to be on that lower end. Is it more predictable in theory? Of course, yes. Why? Because now they've purchased a portfolio, the portfolio is paying, and that those numbers come in and they pay dividends. Okay. Um, if they're still in the capital raising space and they're still buying additional assets, a little bit less predictable. But again, to keep this fair on both sides, make an argument really for both sides and let you all decide what you think is best for you, it is in theory going to be steady but more moderate. 9% is what I would really expect, even though I put 12 up there because there are some funds at 12%. Okay. On the other side, individual notes, potential returns, they're higher. Why? Because there's no middleman, right? A fund is a middleman. They're paid for their expertise to find notes, manage notes, everything else. So yes, you are paying the fund manager through lower returns. That's how it works. If there is no middleman and you're the one who is directly buying these things, then obviously you're going to get a higher return. Is it more volatile? Again, if you own one note, that you carry with that note. If that note steadily performs, you're great. If it runs into problems, okay, it's more volatile. So one could make that argument if you're just starting out. Yeah, it's a little more volatile because again, you don't have the diversification. You have the one single note that you're working on, and you're just watching that note real tightly. But again, as you start to buy a little portfolio of notes, then you start to get more predictable as well. And I would also make the argument, if you know what the heck you're doing and know how to do your due diligence and know how to get these placed and know how to get them recorded, you're going to have a lot less volatility. I've shown even on this Watercooler Wednesday, I've shown so many case studies where a property's worth 120 grand, we're in it for 20. The person's paying $600 a month, rent's $1,500 a month. There's no volatility in that. Okay, that person's going to stay and pay. Why? Because everything is motivating them to do so. They've got the equity, they've got the lower payments. They're motivated to stay and pay. They've got a track record of making payments for 5 years. There's not volatility in that. Okay, so potential returns always going to be higher on the individual notes because again, you don't have that middleman. Fees and costs. On the portfolio side, yes, portfolio managers can get paid a number of ways, and it's always disclosed in the paperwork that most people don't read or understand. But there is paperwork that says how they're being paid. There can be management fees that are taken right off the top. Okay, so that's not really based on performance. That's just based on the management of the fund. There's performance fees. So if they're making higher profits on that, they're paying you the lower profits. They're taking a spread on there as well. They could also go on a salary basis, which I didn't include on here. But those fees and costs are what reduces your returns. That's why, again, you're making lower returns because you're paying somebody to manage and to do all of these other things versus doing it yourself where all you're paying is transaction costs. And our transaction cost, by the way, in real estate notes versus traditional real estate is much lower. You might pay you might pay a broker fee, but that's baked into what you paid for the note. There's cost in boarding a loan, sure. There's cost in recording a loan, sure. A couple $100 here and there, BPO, a couple $100 with title, that sort of thing. The management fees, and what I mean by this to clarify, no ongoing management fees, there are note servicing fees. Okay, so servicing companies are collecting the monthly payment, they're recording it, they're sending the tax documents, they're following up on late calls, so they are servicing it. Um, but there's no real cost to management because you are the manager. In other words, if the servicing comes to you in 90 days and says the payments are late for the last 90 days, we've reached out, we can't reach the person, voicemail is always full, we've sent out direct mail. What do you want us to do? Okay, so at 90 days, the servicing company who's following your management orders is going, what do you want us to do? Are we doing a demand letter? Are we going to get an attorney? What would you like us to go? Where would you like us to go from here? That's what I mean by the overall management of it. There's nothing for you to manage if a note is paying and performing. Okay, even if it's 30, 60 days late, let the servicing companies deal with that. Okay, as long as they're making 12 payments a year, okay, they're late. Okay, there's late fees, so I'm making more money. Let them do their job. So there is no real management if a note is being serviced and if the note is performing. In that same case, if you're in a fund and it's all going well, there's still a management fee. Okay, because they are there at the ready, so to speak. Okay, so you're still paying a management fee on that side versus yourself. Okay, whoops. Risk level. It's one of the things we always address, with people. That's one of the first conversations that we have. That's one of the big attractions of the note business. Risk level overall, due to diversification, you have less risk. You're immediately putting money into a fund. It's diversified across the country through multiple assets, thereby lowering your overall risk right from the get-go. Got it. 100%. You'd have to, there's no argument against that versus owning one note. Again, owning one note by its very definition is not diversification. So, yes, but are there other risks in there? Yeah, the management risk. Okay. Who's managing that fund? How skilled are they? How long have they been in the business? What's their track record? Have they ever been in an orange jumpsuit?
Hmm.
Um, that kind of thing. What do we have here? Who's the management? And it's amazing that most people with all the access to the internet and everything else, most people don't take the time to see who's really running the show on these funds and what their experience level is. You're putting every faith into them that they're going to make the right decisions and hopefully you pick the right fund with the right people. Look, there's a lot of good people in this industry that have funds. No doubt about it. How do I know that? I've trained them. Heck, most of them went through Dwayne and I in learning the business. It's how they got to that level. Okay, so there's some good ones, but there's also people who've been in the business for 2 years and think they're an expert. They start raising capital. Do they really have the understanding to know what to do when markets change? I've said this many times before, when just human nature, it's a lot easier to spend somebody else's money and worry less about risk than spending your own. It just is. And when you're a fund manager, think about it. You're in a situation where you've got to deploy capital to buy assets because you've promised investors a return. Are you starting to cut corners just to deploy capital to keep the investors happy, only to find out that the assets that you bought are not good? And then you have trouble down the road because now instead of buying a bunch of performing notes, you have half of them non-performing. And now you can't pay the dividends, but you had to deploy the capital. Okay. You can't sit on the sidelines with everybody's money and say, hey, everybody, sorry, we haven't invested yet. I know it's been a couple of months, but I haven't found the right stuff. You can't do that. Well, you can, I should say, but most fund managers wouldn't because everybody with their money's going, well, what's going on? I thought
Yeah.
we were going to come in and buy a fund. So especially on the initial capital raise, I know there's an attraction. Hey, be the first one to get in the fund. We'll lock in lower management fees. That's probably the riskiest part to get into a fund is because they got to start deploying capital, but do they have enough?
Yeah.
Are they ready to get going?
I
Are
was
they going
getting
to
ready
get
to.
pushed into positions where they make poor decisions that they normally wouldn't make, especially with their own money? Sorry, Dave. Go ahead.
No, sorry, I wasn't trying to interrupt, but you know, or you'll have somebody that is says they've been in the note business for 10 years and now they're starting a fund.
Hmm.
Okay, well, how many notes have you bought in the past 10 years? If they tell you five, or I've done a few, but now I'm starting a fund for the very first time, I would be a little reluctant with that.
Yeah. And there are some people
It's
who
way
train.
different buying an asset versus managing a big fund.
Yeah, and some people train that way. It's like, hey, when you run out of money, just start a fund. And it's like, oh, okay, how do I do that? And then they start learning how to raise money on a fund. Great. You can have people that are great at raising money on a fund, but not managing it,
That's right.
making poor decisions. So management risk is always there. So if you're getting into a fund, see who the management is. Look at their experience, look them up, ask questions. If they're evasive, if they don't want to answer questions on it, there's a reason. Okay. So do your homework on that. What about risk level for your own notes? Is there a risk? Of course, there's risk in notes. People lose jobs, people get divorced, right? People die. Okay. So payments stop. Okay. If that happens, what's your risk? Foreclosure. Okay. So if you have one note and it goes into foreclosure, are you having higher risk? Yes. But let me put it to you this way. You manage the risk. That's a part of your due diligence. The example I just gave you, $120,000 home, and they owe 20,000 bucks that you paid 19 grand for. Okay. You've identified the foreclosure risk already. You know what that risk is. Okay. And both time and money. And at the end of the day, if you buy right, it's not risk. It's really just an inconvenience of having to go through that process. Okay. So yes, it's mitigated by experience. When you learn how to do this the right way and you manage your risk, which is always the first thing that I look at, because if you don't buy right, at some point in time, it's going to come back and bite you. Okay. Sometimes new investors fall in this trap of they just, kind of go in half educated and they buy something and it works out. Person pays. Great. Business is easy. They buy another one with the same low level of due diligence, and now it goes the opposite direction. And now they're losing money. Now they're starting to think, how can I get out of this and lose as little money as possible? Okay. So you mitigate your risk by experience. Okay. Um, so there's no other way to put it, and so experience can come with lumps. How do you lower your experience knowledge? Well, you got to work somebody with the experience then. That's it. Learn from other people. That's why there's mentorships that I have and that sort of thing, right? That's what lowers that or accelerates your experience, thereby lowering your risk. Excuse me. Okay, liquidity. On the fun side of things, read the paperwork again. Your money could be locked in for at least a year. Some funds that are now on the more looser SEC guidelines that do allow the group funding and that sort of thing. Didn't say that right. What's that? Crowdfunding. Those oftentimes gives you backdoor that will, to the best of our ability, we will be able to get you out of the fund if you need to be able to pull out of the fund. But that's not always going to be the case. It's to the best of their ability, everybody. And if it puts that fund in a situation where they're taking on more risk, your funds are locked up. Okay. So read what the initial lockup is. If there is any redemption periods, do not fully count on those. So the whole thing is if you don't have enough money to put into these things like a stock where it could go up and down, but you're not selling, it's money you can't afford to lose. It's locked up for a period of time. Okay. So you've got to read the paperwork and see if they have any redemption periods, and if so, when do those start? And is there a penalty for it? Okay, because imagine this: you're trying to run a fund, and people put money in. They go, "Oh, you know what? I forgot we have this debt now to pay off, so I want my money back. And it's like, well, your money's been a part of a pool that we've invested in other assets. It's not like we can just decompartmentalize your money and send it back to you. So a fund has to have, for management reasons, they've got to know what kind of funds that they are dealing with and not have unexpected people going, hey, I need my money back. And that's why, going back to my earlier point, most of the funds today, they want accredited investors, because accredited investors are the ones that will keep the money there. They're not going to be requesting it out because they're not dependent upon that money. Okay? And that's why most small investors are locked out from funds anyway. With individual notes, you own the note, you own that asset, and it is an asset. So can you liquefy that asset? Yes, we have a very, very liquid market today. That's one thing that comes up a lot when I'm talking with people. They go, "Gee, I don't know if I want to invest in something and lock up my money for 20 years." I'm like, "How are you locking your money up for 20 years? You bought 20 years worth of payments, but you could sell all those payments next year, the year after, 3 years from now. You can sell them." Right? It's very, very simple. In today's marketplace, priced right, you could resell a note within 30 days. See it all the time. So you've got, yes, an investment that you can invest one time for 20 years worth of payments, one effort, 20 years worth of payments, but you always have the, hey, you know what? Hospital bills came up, unexpected something happened in life. I want to pay for my grandkids' college, something like that. You go, burp, let me sell all or part of this note on the open market. Simple. I have students that do that all the time. They come to me and say, hey, I bought this note 5 years ago. I'm looking to diversify a little bit, or I had some unexpected things I want to do. I'm looking to resell the note. And I help them with, all right, well, let's price. If you price it like this, I know that one of my other students will buy it. And sure enough, done. Okay. So it's a very liquid marketplace because you own the individual asset. There's no question about it. You're locked in on the group side. Control.
Hmm.
There you go, Dwayne. In a fund, I put generously limited input, and that's even probably too generous. If you put your money in a fund,
That's it.
you don't make any decisions. You've
You're
given
being
all of that up.
generous with that.
They're not
You're
having
being
group,
generous with that.
yeah, they're not having group meetings and things like that. Look, if it's a smaller fund and they've raised $2 million and you're $1 million of it, you might have some limited input. So I'm being very, very generous on that side. Think of it this way, though. If you're investing in a fund, that's it. You have no decisions. Okay. They make all of the decisions on the management. That's what you're paying them for. So make sure you have good fund managers that know what they're doing. Again, it all starts to tie together on here. If you're buying assets yourself on the individual side, you're in complete control of everything. If you're partnering with somebody, who's the majority partner? Is there agreement that they have final say on some things? You can divide up things where one party with a smaller ownership manages it, oversees it, makes decisions on your behalf, but there might be certain decisions where you say, hey, I want to sell the note. Do you have the right to do that? Okay. So, yes, even if you partner with somebody, there's who controls, who makes final decision. With my partnerships, I manage the whole thing, but on big decisions such as they want to sell all or part of the note, they make that decision. They own the majority of the note. Okay, it's very, 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 very simple. But they don't want to make the day-to-day management stuff. They leave that to me. Okay, and that's what I do. So there's ways to break all of those things down. But the point being, practically zero control in a fund and high control when you own your own asset. And that should be pretty. Did you have more comments on that, Dwayne?
No, I interrupted you enough. No, I'm good.
Mm. No, not interruption. No.
Yeah. No.
Okay, who's suitable for what? And again, trying to be very balanced here for you. Beginning beginners, passive investors, those seeking just to deploy capital, not do anything. Is there an attraction to funds? Yes. Okay, because of reasons that we talked about. Are there drawbacks? Yes, because of reasons that we talked about. I don't think you'll find most more advanced passive investors investing in funds. Why? Everything we talked about. They can make higher returns, they're in control, they know how to mitigate their risk, they know how to outsource things that they are not going to do, such as note servicing. So it's a higher attraction at that level for people who are more advanced and still want that passive type of income. Okay. So experienced investors, they like the individual notes. They're the hands-on type. They're a little risk tolerant as far as, again, you're not just putting money in a fund and instant diversification. You're putting your money into a note. Is there an attraction on the individual note side for the beginning investors? Sure, of course, for all the reasons that we talked about. So, in knowing all of this, you can see why I created the programs that I created. If we identify what are the potential issues on the individual side and we address them and fix them, it makes it attractive for all investors, beginning and advanced. So, for example, in my programs on the mentorship level, you've got me as an expert to help you through everything. So when we talk about here experience, mitigating your risk and everything else through experience, you're getting my experience. Okay, because you're able to work with me on a one-on-one basis. I'm your expert that you come to and say, hey, here's what I'm thinking about. Is this right? Is this wrong? How do I protect myself in this? What do I do? So if you've got somebody like that that's working on an individual level, we're not talking books and tapes here, on an individual level with you, you could see where now all of a sudden the scale starts to shift to go, well, gee, it makes much more sense for me being in control. I've mitigated my risk to a certain level. I'm making higher returns. I've got the liquidity that I need, and you can address all of those issues. It makes perfect sense. That's why I also created my elite level program where I partner with you. I put money in the deals with you as well. I find the deals. I do all of those things with you to address these other issues. Now you're a passive investor where things are being managed for you, but you're not paying a management fee. You're not making a lower return. With me, I'm actually putting money into the deal. So if I'm 10% into a deal with you, I'm paying 10% of the cost, 10% of the investment, 10% of the cost, and I'm making 10% of the payment. You're in it for 90%. So you're paying for 90% of the deal, 90% of the cost. You get 90% of the payment. And guess what? Our yields are the same. I don't cut into your yield. If we buy a note at 12%, I'm making money on my contribution, 12%. You're making 12% on your contribution. So you've got all those benefits of a fund without being in a fund. That's why I created it. Okay. To address those issues, because funds can go out of business, everybody. They can. I know they're attractive. I know there's some good sales presentations for those funds, but here's just three examples. This one was in 2024. Florida-based firm raised $56 million from 660 investors nationwide through promissory notes, asset to income program, promising 12 to 99% returns. Come on.
Uh,
Red flag. I just told you why 12% is unrealistic. It's
dear
unrealistic
goodness.
to give you an investor 12%, let alone 99%. That's insanity. In the note business, it's not realistic because you can't buy enough notes that are higher than 12% to live up to that promise. You can't do it. Returns backed by supposedly $450 million real estate portfolio. In reality, only $11 million went into the properties, while $28 million was funneled into speculative trading, losing $12 million. Another $6.9 million paid undisclosed commissions. The SEC, gee, I wonder who the commissions went to.
Yeah.
The SEC froze the assets, charged a fund, hitting many retirees hard. Some lost their entire nest eggs. This case underscores how secured notes can be an illusion in unproperly managed funds. 2025, Yield Street. This alternative investment platform offered pooled real estate deals, including debt and equity notes to everyday investors seeking diversification. So now we're investing in real estate and we're investing in real estate notes. You're going to be really, really diversified between equity in properties and debt on properties. Great. Sounds good. It is good. Of 30 reviewed deals, four were declared total losses. A Nashville project wiping out 300,000 for one investor. A real estate investment trust shut down after its value dropped by nearly 50%.
Oh,
Okay. Locking up funds for years. Okay. Rising rates exacerbated issues, but poor due diligence in projects led to widespread defaults, investors facing calculable damage, with some losing six figures, highlighting how to fund opacity can amplify market risks. Probably the biggest one that I'm familiar with, Dwayne, was this one. Peer Street. Peer
mm,
Street was a huge crowdfunding platform. Oh boy, the darling of the real estate world. I remember when this came out, and I had so many people going, I don't know, in Peer Street, I can get in with a small amount of money. They own nets, they own debt, and these notes. I'm allowed to buy, fractions of mortgages, right? You remember this?
yeah.
Oh yeah. Yeah, I'm just a small investor with this huge portfolio, and I'm just a little part of this. Easy entry, just sign up right online, do all the paperwork, send in your money. They raised $122 million in funding. It filed for Chapter 11 after originations plummeted from
Wonder why
695
that
million to
is.
5.4 million. Most loans became non-performing. Most loans became non-performing. Okay. And investors discovered that they hadn't bought an actual mortgage slices, but unsecured financial instruments. Okay. So you didn't really own a percentage of the loans. They basically said you own these financial instruments that give you a claim to those loans, not the same thing. Allowing the company to sell off assets in bankruptcy without full repayment. You didn't own the mortgage. You owned an entitlement that gave you part ownership in that. They still owned it, so they could sell it. Losses totaled hundreds of millions of dollars, affecting thousands who thought they had collateralized investments. They exposed the danger of fractional note funds without true ownership.
You didn't own anything. It's like leasing a car.
Without true ownership. And again, the best way and the way that I do this, I own a part, you own a part. I put in money to own that part. You put in money to own the other part. There's other people, everybody, that will go into a partnership with you, but it's a different arrangement. They put in nothing, you put in everything, and they get 50%. They get 40% of the whole deal.
Yeah.
They're not taking any risk. Okay. So again, I could give you other examples of this, by the way, but I think that would be redundancy when you see this. I think those three kind of get the whole thing. Not properly managed, buying fractional notes, but not really having true ownership of those notes. And what was this one? This one, secured notes. So yeah, and just improperly managed. So all these different things that we talked about here. Again, you can screenshot this or whatever you want to do. Go back and listen to this on YouTube. But I think I was very fair in laying out both sides of it, because I'm not anti-funds, everybody. Okay, it may sound like it. There are funds that are well run, but you have to know going in what you're getting. You're getting no control, smaller returns. Great. If that's all you want to do, by all means, get into a good fund run by good and seasoned management that have been through some cycles, not just around. Okay. A fund that is more seasoned, meaning you're not buying in the initial capital raise when things can get a little chaotic. Are they going to raise enough capital? Do they have enough to deploy? You know, are they going to be able to pay dividends because they haven't bought any notes yet? They're raising capital. Okay, riskier time in a fund. I do think overall, though, the best way to do it is individual notes. For all the reasons that we laid out. You're in control. You manage your risk. You handle the issues if issues come up. And if that means that you have to initially invest in yourself first, God forbid, and get yourself a good mentor who's been around, who has the experience. Get yourself a good partner that's been around and has been through some of this. Great. That'll just accelerate it that much quicker because it addresses these inherent issues. These aren't issues that I've made up. I mean, you can research all these various topics. These are facts that are just laid out for you and very balanced approach. So you've got to really think about if you're getting into this, which way am I going to go? Okay. And I think if you study this a little bit, you'll probably come to the same conclusion, But again, there's going to be a percentage of you like, this is good fund. It's good managed. It's got a good track record. I'm just going to put my money there. Nothing wrong with that. Could some of you go, I might do a little of that and I might start to learn the business myself and invest in individual notes. Could do it that way as well. I just know what you're getting into on either side. What do you think, Dwayne?
No, I think you were fair with it. I think it definitely opens the book up in giving people options and opportunities to see the difference between the two. I- but at the end of the day, you hit the nail on the head. I mean, it's really got to be what you feel comfortable with. And knowing my biggest thing is if you're going to enter into the fund, you're entering into the fund and let somebody manage it. I mean, if you're going to be scared to death of, well, what's happening and I need to be a part of that, no, that's not going to happen.
Yeah.
And that's why I'm a fan of the note business just because I like having the control. I don't want somebody else to manage my money that doesn't have complete ownership in it. Just
Mhm.
because they manage it they're creating income for themselves. Doesn't mean that they invested in it, just means that they created it and that they're managing it. And so to me, I believe that there's a difference.
Yeah.
To your point in hand, there are some good funds out there, but these people have been in it for 30 years and people that we know that have been doing it for a long time and they've
Mhm.
proven themselves. But there are a lot of people that don't. And then, I talked to a guy the other day. Well, I'm going to get into a fund and it's my aunt and my uncle, and I'm going to have say, okay, that's a big difference. That's
Mhm.
a huge difference in what's their experience on that. But
Mhm. Yeah.
no, I think it was nicely laid out, and I think you were fair about all of it.
Good deal. All right, everybody. Having said that, you want to learn more, go to kevinshortell.com. You want to listen to a rebroadcast of this, it'll be posted on YouTube as well. And hey, if you got some topics you're thinking about, let us know. If you got some comments, go ahead and put them up there, and I'll eventually go back and check. I don't look at Facebook on a daily basis, anything like that, but I'll go back and check and see what some of your comments are. But you can always go to the website, or emails and everything are there as well. Just go to kevinshortell.com. Remember, that's SHORTLE. Looks like Shortle, kevinshortell.com. And if you're still looking to get more information just on the note business in general, you can go right there on Amazon and get my book, Real Estate Without Renters, a good introductory book, good overview for that. And if you read that book, you should be armed with information to say, I want to do this or I don't want to do this business, and probably at which level as well. So there you go. And I think the book's maybe $20 or something like that. So check that out as well on Amazon. And thanks, Dwayne, for joining me. And thank you,
Yeah, man.
everybody, for tuning in. Do appreciate it. Look forward to talking to you again real soon.